Welcome, everybody. It's a brand new week, brand new month, September 3rd, the market update desk with Scott Riley, NMLS number 157524. We got a lot going on this week in a shortened week because the market was closed yesterday. We hope everybody had a safe, blessed holiday, got to enjoy some time with friends, family, and enjoy the sunshine that was outside as we now kind of go into that fall season. Unfortunately for me, someone that lives for summer starts to get away from my preferred time of the year. So tomorrow, believe it or not, kicks off Jobs Week. Yep, we're back at Jobs Week already. So we get the JOLTS report tomorrow, which is the Job Opening and Labor Turnover Survey. Now, this is a measure of job openings in the month of July. The market expectations are for job openings to fall slightly to about 8.1 million. Now, we got a little bit of a clue from another report that just came out from a company called Lighthouse Data. Now, what they do is they look at job openings for all of the online postings every week. Their data has historically been an accurate precursor to the actual job openings data when we get it. And now what they're showing is a big decline in openings in July and even steeper drop in August. If Lighthouse is correct, and we have every idea and thought that they are pretty much in correct line, we should see a weaker JOLTS report. Now this will, at least to an extent, help the bond market, which will help mortgages. Two other important data points within the JOLTS report are the quit rate and the hiring rate. The last look for June showed that quit rates fell to 2.1%, which is the lowest since 2018 when you take out COVID. The hiring rate fell to 3.4%, which is the lowest since 2013, not include COVID. And actually, it wasn't even that far off from the COVID low of 3.1%. So we're seeing, continued reports that are showing the weak jobs and employment market. And these are significant reports that are going to impact which way the Fed goes on the 18th. The full report for this week is going to be Wednesday mortgage applications, JOLTS report, the Fed beige book, which is always important. Thursday is going to be the ADP report and initial jobless claims. Friday is going to be the kind of that big one for the week, the BLS jobs report. Now, all of these are kind of pushed back a day because we had the short trading week. Now, what the market is looking at is an expectation of 145,000 jobs created in the ADP report, and the BLS report 165. Now, these are big up increases compared to last month, but still less than what we would see in a full force economy. Now, it's also anticipated the unemployment rate will fall from 4.3 to 4.2%. Now, if we get a weak report and the unemployment rate stays or increases slightly, it's going to increase the pressure on the Fed to do a 50 basis point cut versus a quarter point. So this round of jobs report is going to be very important for what the Fed does on September 18th. Now, remember, when the Fed raises or cut rates, that's not a point-for-point application to mortgage rates. Many times, the anticipation of what the Fed is going to do is already factored into where we are currently for mortgage rates. Right now, we're in the low sixes, and it's an unbelievable time to save some money on a refinance. I've got a couple customers in the mid to high sevens looking at refinancing down into the low sixes, save thousands of dollars a year. Don't let the hope of a slightly better interest rate in a couple of weeks cost you money, because whether we get a betterment to mortgage rates or not is not a guaranteed thing. As I said, many of the reasons we've gotten lower rates the last 3 weeks is anticipation of what the Fed is going to do. Fed can always throw us a curveball, keep in mind, as also these job reports can throw us a curveball. We know how inaccurate the BLS has been the last couple of years. So there is a little bit of concern on the accuracy of the data we're going to get this week. Mortgage bonds, we're moving a little bit higher. We're about 20 basis points better. We broke back through a important technical level at 100.79. 10-year bonds, we're actually down about 8 basis points so far this morning, moving back below an important Fibonacci level. Now, if we can get some friendly jobs numbers for bonds, we might be able to fall back under that important resistance level of 3.8. So there's a lot going on this week. We're going to keep you updated on everything. Look to help you out. Give us a call to run numbers for a purchase or refinance. I'll get you pre-approved. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan. 616-293-2189. Have a great start to the week, everyone.